Once again, you're at Real Turkey channel, one of the few English language broadcasting channels on YouTube from Turkey by Turks. Not that we're nationalistic, we could take anyone if we can find. Today I'm going to talk about March 18th syndrome, which is sort of like Freddy's nightmares. You don't want to go to sleep in case you're going to see nightmares. But before I do that, first of all, I am extremely grateful for your comments, whether they are negative or positive. Honestly, with such low traffic, what motivates me to keep shooting these videos is that I know there is a small but select audience out there who enjoys from these and benefits from them. Therefore, whether it's commercially successful or not, I shall continue shooting these broadcasts. There are two more questions I wish to answer. First, I understand a lot of people who speak Turkish or Turkish citizens also watch this, and they insist that we put, subtitles. First, that's extremely expensive. Secondly, it's really difficult to find an economic expert who is also a translator. And I would rather not put subtitles than put subtitles down there that don't reflect the meaning of what I'm trying to say. But I'm trying something new. Just a few minutes ago, I shot a video on my Turkish channel on the same subject. Of course, they're not going to be identical, but if you are using this video to advance your English, which I think is a legitimate purpose, I wish everybody spoke English or some foreign language in Turkey. First watch that video, 18 Mart Sendromu, and then watch this one so that, at least the topic and the flow of argument will be familiar to you. Finally, of course, the most important question, don't you have anything good to say about your country? There are a lot of good things happening in Turkey, but remember, I am an economist and a press member. My job is not to compliment the government or try to market my country. My job, and I think that should be the job of every patriot in every country, is to criticize what's being done wrong and what can be improved. This is how my videos are structured. And believe me, when you put the positives and negatives together, Turkey has great people, great potential, great entrepreneurship abilities, and a geography that the God has blessed us with. But unfortunately, we have very sucky government. So for the time being, unless miracles happen, I shall continue to broadcast videos which are rather negative on Turkey. What is today's subject? Let's do it. Well, it's the March 18 syndrome because on March 18, Turkish Central Bank's FOMC, if you live in the United States, or Monetary Policy Council, if you are living in Europe, will meet to set new rates. And the question is, should Turkey raise interest rates? Or, in my view, the more important question, which is not being raised, is could Turkey raise rates? Now, let me show you the second cover. I really worked hard today. This is basically the flow of argument, once again, for those who are not too familiar with economics or the English language. I'm going to leave it on the screen for a few seconds and show you my whistling skills. So it's better than reading the whole text. Yeah. Among many things I do very poorly, whistling, singing are among them. I can't also play an instrument, any instrument, not even drums. Okay, see, this is the problem. The central bank was trusted to a new governor, Mr. Naci Ağbal, who is a very experienced treasury bureaucrat. I think he will do a wonderful job in terms of navigating Turkish economy with the monetary policy. And he has indeed tightened monetary policy, that is, raised interest rates to 17% per annum, which about a month ago would have been sufficient to suppress inflation, though over a very long period of time. We orthodox economists think that if you have a very sticky, that is persistent inflation, and moreover, very high inflation expectations, the medicine therapy doesn't work. What a central bank should do is take a sledgehammer and just smash people on the head, trying to make them believe that I shall not allow you to raise prices. If you do, I'm going to raise interest rates. That's called shock interest rate policy, and that would require not 17%, but something like 25% interest rates. The problem is, as some of those in the United States might remember, from 1980s, Volcker tried that. He succeeded at the end, but for 2 years, the American economy was in a desperate situation. In Turkey, we're easygoing people, not used to pain, so we don't want to pay this very hefty price for price stabilization. Therefore, Naci Ağbal or any other government will have to go slow on disinflation. 17%, as I've said, might have sufficed, at least to decelerate inflation. But over the last month, conditions changed radically. Usually I blame the government for messing up Turkish economy. This time their only mistake is a hasty reopening of the economy, which saw daily COVID-19 cases go up from something like 7,000 to 775 as of 9th of March, which would require new lockdowns and curfews as far as I'm concerned. But most of the problem with the Turkish economy was caused by foreign shocks. And what foreign shocks? Well, let me show you some charts here. This is the American bond yield. It's not up to date. This morning it was 1.54%. This is the 10-year American bond yield. You see, since July 2020 or so, it has increased from 40 basis points to 160 basis points. Now, if you live in a developed country, well, it's not that important. I mean, maybe your mortgage costs will go up somewhat, but not to a significant degree, not to the degree that you would change your decision to buy a house. But in Turkey, it's different because we are heavily indebted to our foreign creditors, and we need to borrow $180 billion a year, which means when your borrowing costs are more than tripled in a month, you currently suffer. There's another problem, which I didn't show on a chart. At the beginning of the year, everyone and their uncle or aunt was a dollar bear. Everybody said, well, fiscal stimulus, monetary stimulus, the currency will crash. Who knows? Maybe at the end of the year it will. But currently, rising American yields are pushing up the dollar index too. Why? Because, well, when Germany's 10-year bond yield is minus 0.2% and America offers 1.5%, you pull your money out of Euro and Germany and invest it into the United States. For that, you buy dollars, dollar index goes up. So, this duo of higher bond yields and rising dollar index is poison for emerging markets, and Turkey is an emerging market. By the way, I broadcast a video asking the question, is the world hurtling towards another financial crisis? You may want to take a look at it. I think that possibility exists, and it's not trivial. Also, I explained some of the external factors on the Turkish economy in March. The Four Horsemen of the Armageddon. One of my better titles, if you ask myself. Turkey has another problem, which is the price of Brent crude. Look at this graphic. It is almost up to date in the sense that today uh, Brent crude in Asia was trading at $67. I'm sorry, $67 per barrel. Turkish economists as well as the central bank projected Brent crude prices rising to $55 at most at the end of this year. Everybody was shocked. So was Turkey. But the problem is, every $10 increase in Brent crude prices adds $4 billion to our current account deficit, which means, the lira comes under pressure. And depending on whether they're implemented at home, 1 to 1.5% to CPI. So, because of these factors, Turkish lira depreciated. Up until 3 weeks ago, Turkish lira was the darling of the financial investment community. People were saying, well, the times of the dollar are over. It's the time for currencies like Turkish lira. Great interest rates, great carry. Lira will appreciate. I've seen forecasts of dollar TL as low as 6.3. Then suddenly, dollar TL shot up to, as of today, 764. Put it differently, in a month or so, Turkish lira depreciated roughly 10% against the dollar and euro, or a combination thereof. Again, there's a simple rule which almost always works. A 10% depreciation in currency adds 2% to CPI over a year, but most of that extra burden comes within the 3 months. That's called the pass-through coefficient. It's 0.2. So you have an inflation at 15%, even if there are no pressures at home, and there are, for instance, the drought driving food prices up and normalization increasing demand faster than supply. Just Brent and the depreciation of the lira would add probably 2 to 3% on top of the current CPI, which would raise it to 18% in a few months. The policy rate is 17%, and if it is negative, obviously now nobody is going to hold Turkish liras, whether that person is a Turkish saver or a foreign fund. So central bank is forced to raise rates. Currently, I'm really sorry. I read reports by major investment banks. They say, well, 100, 150 basis points. In my view, that's not sufficient. The central bank needs to get ahead of the market. It needs to raise interest rates at least by 300 points. Can it? Well, this is where the March 18 syndrome starts, because there's currently a very loud argument and also two-way trading in dollar TL between those who say, nah, President Erdogan hates high interest rates. He will never allow Mr. Naci Ağbal to raise rates any more than he already had. As you know, most major banks are independent. In Turkey, everybody is dependent on the president. He makes all the life and death decisions about us and institutions. But there is another argument here which is missed. Usually, an old, traditional, orthodox economist like I would say, yeah, raise interest rate. Inflation is the biggest problem. I am not that comfortable to recommend to Mr. Naci Ağbal, if he were to ask me, which he never, to recommend him to raise interest rates. The problem is Turkish corporate sector is very heavily indebted. As I've said, banks and the corporates have to pay $180 billion of foreign debt, and the numbers overlap. So there's some counting twice. but also Turkish individuals, households, and companies have 3 trillion liras, or roughly $500 billion of loans outstanding. And let me show you what happened after Mr. Naci Abal tightened initially. This graphic is in Turkish, but it shows the trend growth rate of bank loans. And red is total loans, blue is state banks, and green is private commercial lenders. As you see, the momentum, not the actual credit the credit issuance, but momentum has declined to zero, which reveals to me that even at the current interest rates, the banks are wary of credit risk, and individuals and corporates are wary of not being able to afford this high interest rates with their sales, profits, or with their incomes. So now imagine you raise the benchmark rate, the policy rate, by another 300 basis points, which would drive loan costs anywhere from 3 percentage points to 5 percentage points, depending on the creditworthiness of the borrower. And you may have a massive insolvency crisis in your hand. Obviously, the mega corporations are going to be immune, but the small and medium enterprises, which are already suffering from low domestic demand and these curfews and closures, are going to suffer massively. And there's another problem. If these corporations go bankrupt, they will, of course, shed their employees who will not be able to pay their loans. So we're in a typical catch-22 situation. I am not so sure that monetary policy is the remedy to Turkey's inflation and weak currency problems. And you really can't use fiscal policy. Read the OECD interim report, which was published yesterday. It strongly urges governments to keep monetary policy loose and to use all fiscal resources to provide financial aid to small corporations and to unemployed individuals. Turkey is already doing very little for its poor, for its unemployed, for the small merchant. Further budget austerity is not going to be useful. So you might say, well, are we dead? I mean, are you the Mr. Doom? No, I think there is a very easy solution. Mr. Erdogan has already unveiled a democratic reforms package called Human Rights Action Plan. And as you watch this video, he will have announced an economic reform program. Unfortunately, the Human Rights Action Plan was completely fictitious. It was worse than fantasy. Because as you speak about democratic reforms, you are also plotting to close one of the legal parties in Turkey, the HDP pro-Kurdish party. And you use the judiciary to put pressure on your political rivals by suing them for any reason whatsoever. And political prisoners are not being released. So the package lacks sincerity. When you have a lot of credibility as a government, or as a central bank, or as a bank, your promise is a contract. This is why credibility is important. By simply promising, you will achieve results as if you have already done what you have promised. If you have no credibility, that's the analogy to the kid who cries wolf every time he runs into the village. You have to deliver. You have to pay cash up front before people take you seriously. So instead of using monetary policy or fiscal policy, which in my view are basically stuck at this point, if I were in Mr. Erdogan's shoes, which I don't want to, I would immediately release Turkey's symbol political prisoners, Mr. Osman Kavala, Mr. Selahattin Demirtas, and his lawsuits against political rivals. And on the economic front, I will immediately task our economy czar, Mr. Lutfi Elvan, with a new crisis budget that's cognizant of Turkey's current realities. How can we feed the poor but at the same time save on other items. Uh, we have to have a comprehensive program that addresses monetary fiscal incomes policy as well as reforms, and to make sure they all work in sync. What would be achieved if we announce a program like that? Well, right now, money is flowing, in fact, flooding the emerging markets. I think only in January, China received $30 billion just in bond investments. Obviously, we're not going to get that much, but we don't need that much either. I mean, for the last 3, 4 weeks, Turkey didn't draw any financial capital or FDI whatsoever. If we can get $2, $3 billion a week in for a few months, obviously that would solve the currency weakness problem. And as I've said at the beginning of this video, when the currency depreciates by 10%, it adds at least 2% to CPI, but also it's a symmetrical relationship. If the Turkish lira appreciates by 10%, inflation goes down by 2%. So what we really need to do is not mess with the dials of monetary and fiscal policy, but initiate and enact genuine, concrete, and immediately implementable reforms. Otherwise, whether we raise interest or not, we're at the mercy of US bond yields, the dollar index, and oil prices. We may get lucky, then again, we may not get lucky. This is Atilla Yeşilada for Real Turkey channel. Thanking you one more time for watching another video and wishing you a healthy week. Bye bye from Istanbul.